let me start by saying that it's a real pleasure to be here in Seoul, participating in this very exciting conference, and my thanks to the Korea Development Institute for its wonderful hospitality. This is the session that we're going to devote to the issue of exit strategy that John already alluded to during his introductory remarks. And in particular, what we're going to do here is to look at what is the right strategy for renormalizing monetary and fiscal policies in advanced economies. So the plan is that I will start making some general remarks on the exiting processes and on monetary policy, and then Paolo Mauro will deal with fiscal policy and then conclude. On the exiting process, I think it is clear that without the interventions that we have had during the past couple of years, the world economy would have gone into a Great Depression. So we're thankful for these interventions, both at the national and at the multinational level. But it's also true that there has been a legacy coming from these interventions in terms of very large levels of public debt, of a very significant involvement of the public sector in the financial system, very low policy interest rates, very large central bank balance sheets, and then in terms of the reform process of the international financial sector, there's been uneven progress, and there remain still with us some signs of financial vulnerabilities, and other signs are growing, like those relating to sovereign credit risk. In the exiting process, it's clear that the goal is to move to strong, sustained, and balanced growth, but it's key that we respect or that we put in place the following preconditions in terms of price stability, in terms of the sustainability of the public finances, in terms of enduring financial stability, and also well-functioning markets. So the exiting process is going to deal with four dimensions, with the monetary policy dimension, the fiscal dimension, the financial policy dimension, and then all of those things related to market structure, in particular financial regulation, but also competition policy. The exit strategy should be within each country cohering among the different policies that need to be articulated, should be market-based, should be attend to the specificities of the given country, but should also be international consistent in order not to create problems. The timing is also key. The timing of the exit must be consistent with the maintenance of financial stability and the sustainability of the recovery. And it's very important that we reserve the flexibility which is necessary to deal with unpleasant surprises down the road, and if something unpleasant happens, to avoid that we restart again the negative feedback loops between the financial system and the real economy. And of course, these strategies need to be clearly communicated. And the expectation that there would be also some unwinding of the conventional measures in terms of interest rates. This is a map that we have drawn on the basis of an index of the degree to which conventional and unconventional monetary policies have intervened during the crisis. And you can see there, depending on the color, where interventions have been lighter, like in the case of Australia, or whether interventions have been stronger, like in the case of the United Kingdom and the United States. And what you can see also is that going forward, our expectation, based on the plans that have been laid out or at least indicated by the authorities and market expectations concerning interest rates, the expectation is that the exit would be happening during this year and beyond. The issues faced by central bank in exiting, I think, are of two types. Issues that they will be facing in the short term and issues they will be facing in the medium term. In the short term, it's clear that interest rates have to be, Interest rates have to be increased from the very low levels that exist nowadays in the major economies. And regarding the management of post-crisis balance sheets, which have increased very significantly in the major central banks, in the Fed, in the ECB, in the Bank of England, in the Bank of Japan, it has been a lot more muted. Balance sheet increases that came after the room for maneuver for conventional monetary policies was exhausted once interest rates reached the zero lower bound, and also as a result of the implosion of the money multiplier, particularly after the Lehman Brothers breakdown. So in managing these swollen post-crisis balance sheets, central banks will need to pay attention to winding down their liquidity providing operations and also to managing the long-term securities that have been accumulated during the crisis. If one looks at the central bank assets of the major central banks, again, one can see certain interesting features. One feature is that both in the case of the Fed and of the Bank of England, the amount of reserves that have been into the system as a percent of GDP are now significantly higher than before the crisis, and also significantly higher than what was the case in the lower part of the crisis concerning the ECB, for example, in the Bank of Japan. Also, the size of the other items in the central bank balance sheets, like liquidity facilities or liquidity provision and asset purchases of the private or the public securities in different colors, is much higher as a percent of GDP in the case of the Federal Reserve and the Bank of England than in the case of the ECB. And in fact, in terms of the composition of the key balance sheet items, in the case of the ECB, almost everything has been in terms of liquidity provision, while the purchase of assets has been lately the prevalent mode of intervening on the part of the Fed and of the Bank of England. The difference being that the Bank of England, it has been public debt purchases, while in the case of the Fed, it has been public debt purchases. These are the blue bars, but also private debt purchases as reflected in the red bars. And in the medium term, I think the main challenge faced by central banks, and it would have been hard to think that we would need to talk about this thing today, let's say 5 years back, is to preserve their independence in all dimensions and to continue monetary policy focusing on price stability, which is the only thing that monetary policy can really deliver over the medium term. In terms of the adjustment of policy interest rates, I think it's fundamental that in this transition period of renormalizing a monetary policy to remain consistent with price stability, that inflationary expectations are anchored. That must be a fundamentally in the radar screen of central banks. But having said that, I think it's fair to say that in most advanced economies, inflation expectations are contained, capacity utilization is low, and the leveraging processes are still in train, and all of this is indicative of low inflationary pressures. Still, in adjusting interest rates from the strategic point of view, I think it's fundamental that central banks avoid falling behind the curve and that pay due attention to the long and variable lags with which monetary policy affects output and price developments, and also pay attention to the key uncertainties that they would have to face. The uncertainties concerning the measurement of potential output that has been distorted by the crisis and by the financial technology shock that we have had. Uncertainties coming from the changes in risk premia, again coming from the crisis, from the fiscal policy uncertainties, whether fiscal policy authorities would be able or not to respond to the daunting challenges that are facing them, and which Paolo will turn to in a minute, and also the uncertainties remaining concerning the financial vulnerabilities in the economy. So more than ever, monetary policy will be an art rather than a science in the transition period, in the exiting process. And from the operational point of view, the adjustment of interest rates is fundamental. That again refocuses on the policy interest rates as the key tool for setting the monetary stance and for communicating the monetary stance after all the measures that were introduced in the past. And contrary to those who say that having an accumulation of excess reserves in the banking system is a problem for carrying out the necessary renormalization of interest rate policy, central banks in the major economies have the tools available to steer money market rates, even in the process of excess reserves. And policy rates can also be raised by keeping some of the crisis measures in place. So there is no need to start unwinding unconventional monetary policies if you really think that you have to tighten interest rates, because that's required by price stability. Let me now mention something about the exiting from the unconventional monetary policy interventions. Their liquidity support is for the most part winding down in major economies, and this is natural as conditions normalize in interbank markets. And as concerns the asset purchase programs of central banks, the logical thing is to discontinue first the purchases if financial conditions are stabilized. That's the flow issue. But then the challenge is how to dispose of the accumulated securities, particularly those who are long dated with long-term maturities, which are now inside of the central bank balance sheets as a result of the interventions during the crisis. And this is the stock issue that requires more active management and sales plans. We should be state dependent, depending on economic and financial market conditions, and where we have to acknowledge that there is the potential for losses in some cases derived more from the accumulation of public securities rather than private securities, if nothing else, because the credit risk of the private securities has been guaranteed by governments in those cases where central banks have taken up these private securities. But the potential losses concerning public debt securities when interest rates go up, those are still there. So going now to the medium term, I think it's fundamental that in the tail risk event that these losses were to materialize in central bank balance sheets and that they could threaten the financial integrity of the central bank, governments should really take up measures to avoid that. Because preserving the independence of central banks in all dimensions, financial dimension, the operational dimension, and the institutional dimension, would be very important in the future, both to cover these losses and to stand potential political pressures on central banks to reduce the cost of servicing the public debt, given the very high public debt levels accumulated by governments. We know that at the end the strategy is self-defeating. It leads to higher nominal interest rates and real interest rates if risk premium increase and if inflation expectations increase, but the temptation, the political temptation could be there. So it will be very important that central banks remain fully independent, and also that the regulatory initiatives that are in place in a number of countries and that might involve modifying the institutional architecture of central banks are also fully respectful with the need to preserve the institutional independence and also of maintaining monetary policy focusing on price stability, which is the precondition for sustained economic growth. So let me stop here and let Paolo go to the fiscal side.